So are the bears or the bearish thinkers controlling this market? If I spoke to someone who looks at things, the glass half empty versus half full, I think they would tell you that yes, the bearish sentiment is controlling this market. We're seeing interest rates go up 9 times in the past year. And as of 2 p.m. this afternoon, it'd probably be a 10th time. We're seeing a slowdown right across the board in all sectors of the economy. When you listen to CEOs of large corporations in the United States and Canada, and really right across the world, they all say the same thing. Business is going well or okay, but it's definitely slowing. And when you look at business slowing, and we've talked about this in previous shows, when you look at the earnings of these businesses, let's say all the businesses that trade or make up the S&P 500, and then you put a multiple on those businesses, let's say 7 or 18 times earnings, which is your premium as we call it, you end up getting an S&P 500 number of in and around 4,000. Well, as I've said in previous shows, the S&P is trading at 4,100 right now. So at best, maybe the S&P is at fair value or maybe even overvalued. So that's what the bears are going to tell you. Lastly, and most recently, the financial crisis in the US. Seeing these regional banks fail, we've now seen 3 of them fail, and we'll speak about First Republic a little later in the show. But with the banking crisis, or mini crisis, if you want to call it that, in the US, we're seeing credit dry up. These banking institutions, the ones that are left, the regional banks that are still doing very well, they look out and they say, okay, well, maybe we're going to have some new rules coming down on us that will prevent these banks from lending as much as they have. The banks themselves, they don't want to lend as much because they want to keep as much of their assets or cash on hand. Because if we do see a continued run on the banks, if people continue to take their money out of the banks because they can get a higher interest rate on a government bond or a money market fund or GIC, for example, banks want to have cash or at least more cash on hand in case they need to tap into it. So banks aren't as quick to lend. We say credit is starting to dry up. And we know that regional banks make up more than 50% of the loans to small businesses in the US. And we know small businesses in the US and Canada, that's what really drives our economy. So if we have a slowing economy, we have credit drying up where banks aren't as willing to lend, how are things going to move forward? How can the stock market move forward? And here you have a few charts we have. One of them, again, we've seen before. This is the Fed funds target rate. You can see how much it's gone up, showing that higher interest rates causing overall slowdown in the economy, causing a slowdown with the banks even, because as I said, if you can get a higher interest rate now on a government bond because interest rates have gone up so much, that's not going to be a good thing for the banks. Once upon a time, we thought higher interest rates is good for banks because they would make more on the loans that they provide. But I guess everything in moderation, right? If they're having to fight back all the people that are pulling money out because they can get higher interest somewhere else, then it's not necessarily a good thing. So everything in moderation, everything in a balance always is best. A second chart we have here actually is one on retail sales in the US. We can see how much retail sales is starting to moderate now. Retail sales has been very, very good. It still is very good, but definitely starting to come down. So wherever you seem to look right now, the bears seem to think that they have things under control, that shorting the market, as we've heard in the past, might be a good idea. Betting on the market coming down, stock market falling, investments falling, might be an idea for a lot of investors. I don't think it is. And we're now going to move over to the bull case.